Good evening, everyone. Welcome back to our startup series again. And over the last couple of months, I've been fortunate enough to meet with a lot of startup founders across the country. And one of the most common challenge they spoke about, as with most of the startup, is funding. Today, we will look at peeling back the layers of this topic that is the core of every startup's journey. And to do that, we have guest speakers today, angel investor and venture capitalist. A quick round of introduction before we dive in. Good evening and welcome again in another edition of my startup series. I'm Govind Kedia. With my team Arctic Invent, we aim to help companies increase their enterprise value and protect them against copycat by way of building strategic IPR portfolios. Here to decode the angel investor mindset is Sambhav, a senior consultant, our dear friend with Startup Movers. Have been in touch with him since very early days of when I was starting Arctic. Uh, Great guy, and I welcome to the Startup Series. Sambhav, can you so welcome to the Startup Series? And before we start, could you please give a very quick round of introduction of yourself, and then we get Rohit on the call as well.
So that's that. It's nostalgic to be talking to you in this forum. It's the story goes a long way back, and that's exactly a summary of the introduction I would like to put forward. I'm a qualified chartered accountant. I've worked extensively in the startup ecosystem since 2010, seen this one whole cycle of ups and downs. As a senior consultant with Startup Movers, if you looked at a lot of funding rounds, more than 250 rounds that we've looked at in terms of compliance and fund closures, and the expertise lies in strengthening the backbone, which is legal and finance function, right from day zero. That's what we do in this ecosystem, and happy to have a mutual learning discussion today.
Great. Thanks. Welcome, Sambhav. And sharing the merits and dynamics from a venture capitalist lens is Rohit Krishna, general partner at WEH Ventures. Welcome to Startup Series, Rohit. And if you could give a bit of background of yourself to our audience, that would be great start for
Yeah,
us.
sure. So thanks a lot for having me, Govind. Very nice to be here. So I'm also a qualified chartered accountant, incidentally, and I started my journey on the debt side of things with debt rating at Moody's, and then I spent a couple of years at Spark Capital on the public markets, and then finally in 2015 is when I entered the VC space, the early stage venture capital side of things, and uh, this is an asset class I really like. So from 2015 onwards, I've been doing exactly the same thing, which is funding startups at the pre-seed or seed stage. So we launched the fund WH Ventures in 2017, and now we're investing from our second fund, which is almost getting to closure.
Great. Thanks for sharing a very quick introduction. And let's start with the basics. Can we kind of talk about who exactly is an angel investor? Is do they have really the ring on their head and a venture capitalist? And what do each of these roles entail, really, right? Maybe let's start with Sambhav. If you can, share your views on just to get the basics of this topic. What would you share?
Yeah, I think from the Indian startup ecosystem perspective, the angel investment dynamics are changing rapidly for the last 4 5 years. What we've seen coming from the West versus given the demography and the dynamics that our population has, angel investment is kind of becoming an asset class right now. We are aware of the angel investor terms, like you said, the angel with the ring, somebody who's helping the startup grow from a very early stage. So there are that two layers of, I would say, two parallel layers of angel investing that exist today. One, of course, are these very early stage investors, seed stage investors, who are interested in the sector dynamics, industry dynamics, want to work with a startup which they can synergize with, have an active role in it. And then there is this asset class which is like co-investing at a very early stage with other lead investors in this ecosystem. But as I said, it is very early stage investment, probably maybe pre-revenue stage. Angel investors actively might not have a role in the company. So one oxymoron statement that we use is angel investors are those active investors that have nothing to do with day-to-day operations of the company. So they might be the right angels for you to take you to the VC stage where you can raise the subsequent rounds, or they are those high risk takers that have invested at a very early stage, taking the risk where there is no traction. They are investing in with their own money. It's not a money that they have taken from some other debt fund, or it's a conglomerate or something. and most of the times they might be at a not even at a product market fit stage. So they might be coming in at a problem fit stage where they'll assist for that product market fit to be established, where for the scale the VCs will jump in. So that's a little summary of how and why the angel investors exist, at which stage they come in. For the VC part, I'll let Rohit take that away.
Yeah, see, fund again, like Sambhav mentioned, is fairly straightforward. Meaning, we take capital from LPs, and as GPs, we put a percentage of the fund, and we invest the whole profit into startups, ideally, right? Now, there could be seed stage, pre-seed startups where we could be investing along with angels, or it could be a Series A, Series B growth stage sort of funding, where the fund stays more of a center stage and invest where angels are probably not involved as much, right? So here the decision is taken by the GPs along with some level of IC control that we have. And the funds, the only major difference I can think of apart from where the capital comes from is that we try to think of our investments as a for the whole fund, right? Like for example, if from a fund, if we're investing in 12 companies, we try to look at all the 12 together as opposed to looking at a 10, 100x return for one single company. So it's more of a portfolio approach, and we necessarily would have to do it because a good percentage of these companies would have to get to a decent exit for the fund to perform really well, right? So that's the one difference in approach from an angel investor to a fund. But happy to answer more further questions on this.
Sure. No, thanks, Rohit. And I think my experience has been working with startups in this space has been that angels come, like Sambhav said, very very early, and of course they are investors. End of the day, their money, they are there to provide support, but they're also looking return in exchange of that risk, right? So I think that's what I always say, that angels are and ventures are not versus, but it's like together. So I would say that my understanding has been in this area that Angel has been really really great ecosystem in India now with the early stage startups. It became so democratized that people are now willing to put 1 lakh rupees. Even the people have tried 5,000 rupees even with some platforms. So I think this is really really changing. But now the question is, at what stage business funding is really needed and for what purpose? Somebody, you have been working with startups since very long time. I'm sure you have seen from idea stage startups till probably till the unicorn level of funding and so and so forth. So what has been your experience? At what stage one should really think about funding? What scale? What are the factors that should affect these conversations? Some insights will be really helpful for our audience today.
It's a pretty subjective question full of variables. There is no one cut answer where we can build a metric of, oh, now you should raise fund, now you should not raise funds. We've seen people not having an entity and having a term sheet from an institutional investors. And we've seen companies bootstrap profitable till about 5-10 crores of revenue and then going for a funding round. So typically, as I said, there is no one sort of metric where we can put it. But as I said, why we need to answer the three things: why we need funding, where we need funding from, and how we are going to use that fund. These three questions typically should always be addressed, because at times now, of course, post this liquidity fiasco, the things have filtered out. Now it's not the funding craze, it's the unit economics and the profitability craze that exists today. And what has that then resulted in is oh, if I have a unit economics which is pretty strong and it's a profitable model, why can't I look at that side of the story as well? So from that storyline, we are now slowly shifting to a storyline where founders have a perspective of why they need fund first. Do they need it on day zero if it's a research development organization? So for example, all these research institutes like IITs or ESET incubations in scientific universities, they will definitely need funds at day zero, even for their research and development activities, where their own funds will not be sufficient. Even the angel round or the grants go up to 1 crore of rupees. Versus somebody coming in a pretty established SaaS-based model, which is already existing. The market size is very huge. It's just about tapping the market, where a little bit of money can bring in that lead flow for them. So there it might make sense Then another aspect is how important is your equity to you? How important is your ownership to you? Sometimes we've seen that happen to a lot of startups where founders are diluted very early on, and then there is no skin in the game, and there was a whole unwinding of the model. Startups have gone down, even good ideas. So right from very early stage, can you defer the funding requirement up to a stage where you can establish traction? Can you bootstrap yourself till that time? Those are few variables, few questions that will kind of give an answer to this question. Do I have sufficient resources? Have I made a pool to take 6 months or 1 year of development of that product? All those variables will kind of give this perfect answer of, I would say, striving towards perfect answer of whether we need funding or not. It can be at day zero, it can be at 6 months, it can be in 1 year. It can be a bootstrap organization. It can be an organization which has raised funds from family and friends. It could be an organization that just raises an angel and then goes to list. It could be an organization that skipped the whole of it and just raised the institutional investment at day zero because of the industry dynamics. So as I said, there is no fixed metric to it. Every founder and every idea will have some subjectivity according to which it has to be answered.
So, Rohit, your views on this, and then we have some questions coming in. I'll also pick in some questions in the, as we go along.
Yeah. No, my views is like the way I look at it is two things, right? One, you need funds to create a product, the first product that you created, whether it's a brand or a tech startup, whatever it is. That could be bootstrapped, like Sambhav mentioned, if you have your own capital, or you can raise some angels or seed stage funds, right? And anything after this, once you feel that there is some early signs of a PMF, the capital that you raise can be for two things. One, you are loss making on the PNL side because the way to reach out to the market is more expensive than what you make from the product, right? So therefore you make a loss. Or you have a working capital cycle which you need to fund. So these are the two items, right? Either the PNL or the balance sheet. So you raise capital for this, and sometimes the capital requirement stops after a period of time. Either you become profitable, or your working capital cycle becomes better, or you fund it through debt. And sometimes it just doesn't stop. You keep raising like Series A, B, C, and then go on, and finally IPO. Hopefully by then you're profitable. Right? So that's hope. So these are the two ways I look at it.
Okay, great. Thanks, Rohit. And now we have a question from Prinkan as well, and very interesting. For an Indian tech startup where the customer base is largely US and the valuation offered is better, is it wise to follow the instructions of the VCs to switch headquarters? I know it's not, but it's a very interesting question. So I wanted to pick up along with the conversation. So what do you think, Sambhav? What's your view?
We have recent examples of biggest of the companies switching back to the gift city. They were headquartered for US for very long. From my perspective, I've seen a lot of these externalizations happening. And to be frank, I could never establish a good takeaway of why it happened. And I could have understood that there was some tax benefit which now are going out because of guard provisions of ease of fundraise, which I think from Indian perspective is also have improved a lot in the last few years. From that perspective, I am a little averse of this externalization. I've always preferred Indian founders to be Indian headquartered and then maybe having US subsidiaries from the customer perspective. So you might need a presence in US because you have US customers. So your subsidiary can be there. But if you have a lead investor who's asking you to be there in that jurisdiction, then it's a completely different story. Versus why I want to do fundraise, and that's why we are kind of as a prerequisite going for externalization without having any term sheet from a US investor, that we are not a big fan of. So depending upon which stage is asking for that externalization to happen, it can be looked at. But from broader perspective, we've not been very vocal about doing such externalization. And wherever we've seen so far, we are yet to see some effectiveness coming out of this externalization in the ecosystem.
Sure. Great. Thanks, Rohit. What's your view on this?
Yeah, see, honestly, I don't think it makes sense. And there are just a lot more restrictions now coming up, which makes it even more non-viable. For example, funds which are registered with SEBI have to go through a route which is slightly more complicated to invest in companies outside, headquartered outside India. And I think the reason, Prinkan, what you mentioned that the valuation offered is better is the wrong reason to switch your headquarters. Like, because this is just one round, right? After that, you'll raise multiple more rounds, and I think if a founding team makes a choice to keep their headquarters in Singapore or US, then you should be ready to raise most of the capital from VCs outside India. If you come back to angels or VCs within India, then it becomes a lot more complicated and it defeats the purpose of switching your HQ to somewhere else.
Sure. Thanks. It was a bit of a pleasant deviation from the conversation, but let's get back to, and thank you for sharing such a valuable insights. I'm sure a lot of people must be encountering the same question when they are early in the journey of the fundraise. Now the next question, which is our main focus of the today, angel and VC fund. Now, what a founder should know about these, like as a basic framework to approach either angel or VCs. What some are the basic ground rules or some of the basic absolute while going to that journey? Rohit, you first this time.
Sure. See, I think when you reach out to VC, what sometimes founders do not understand is that when we acquire a stake in a company, right? More often or that, like 95% of the time, the only way we make money is by selling this stake to someone else or waiting for an IPO and selling it at IPO, right? There is no other way to take the capital or returns back, irrespective of whether you're profitable or not, doesn't matter. So therefore, two things have to happen. One, if you're an unlisted company, your price per share or your valuation has to be decided at frequent intervals, right? For that, you one can raise capital, or two, you should raise capital at least sufficient intervals that you need to require capital first of all. Let's say after 1-2 rounds you become profitable, you don't need capital at all. Then this might not be a great fit for a venture fund, because then you stop raising capital, your valuation then is not decided by any external investor, and therefore you just have to become really large and do an IPO. That's the only way for investors to exit. So which is not an ideal scenario for a VC. So I think this is one important framework to look at. So therefore, you will have to be building a company which is growing really fast. Obviously, everything has to be sustainable, but venture is for funding risks, right? So even if the first 5 years is not profitable, that's okay. That's completely all right. We don't expect things to be profitable very soon. If you are, then going back to the previous question, you would not need capital in the first place, right? So we want to fund models which require capital. So that's, I think, one fundamental tenet of being a VC or coming to a VC for capital.
Great. No, that's a very good insight. Some of your take on this.
I think whether it's angel or whether it's VC, we follow a very straightforward guru mantra of team traction market size, where traction for VC is very critical, but at angel stage at times traction can be discounted if the team and the market size is huge. If the team has established track record and the market size of the problem set that they're trying to solve for is big enough for them to exist with or without entry barriers. So that's one of the one key. There are other metrics to look at, but this is the basic to look at when somebody is approaching or angel is kind of looking at the startup. From the founder's perspective, it's like whom they want to bring on board as of today. Do they want a mentor or an advisor or somebody from the ecosystem who can kind of guide them at a very early stage, which is the angel side of the story? Or they want a VC backing because they know, as Rohit rightly said, you need to continuously grow, and without the VC support, those frequent rounds can become a problem. That's out of an experience that we are saying that not having a VC is also a problem. So these are the two frameworks to look at. One from the angel and the VC side of what they will look, and from the founder's perspective, what is the requirement as of today? Do we need some individual dynamics or synergies to come in, or do we need some professional approach from a VC to guide us to the next stage of the organization?
Sure. No, great. I think that's a really great insight. And I think in my view, what I have learned and I've seen that end of the day, angel or VC, everybody is in the game for the money and the returns, right? And founders needs to really be very clear, whosoever is playing and going to play the game with you, they are going to come for returns and nothing else. Yes, angel would like to mentor and be part of the journey, and VCs would like to put money on the table, but end of the day, the basic fundamental will be that how you are going to give back that money, right? It's other people money, and we often joke in communities, and I in the last LinkedIn as well, we've talked about that it's OPM, other people money. So you don't get into OPM, don't you should not get high on OPM, right? So I think that's the fundamental I always keep as a very basic fundamental of approaching angel or VC, that it's other people money. It's like taking a loan in a different manner, and you have to return in some way or other by adding some returns to it, right? So I think that's a very, very great summary. Thank you for that. Now, a couple of questions here. Again, I'll take a deviation from what we planned, but there's a very interesting question from Vinod. The dynamics of startup fundings are evolving within Indian context. What are the key factors that investors consider today when investing in a startup? Rohit, why don't you take a stab on this question first?
So yeah, I think the focus on unit economics has come much earlier. Usually, it used to be at a Series B stage where investors pare down the financials to understand what is the bare unit economics. But now, at the seed stage itself, you start thinking about it a lot as to whether a model is sustainable or not. Right? Like probably it might have to take 2-3 steps for it to become sustainable. That's fine, but we should at least know what the steps are to get there, because in the end, like you're saying, right, like a lot of companies which are even close to listing where the basic unit economics is not sustainable, but it's been growing and fueled only because of venture dollars. That might not happen as easily as before unless there is like really a lot of excess liquidity coming in the following years, which I don't think will happen. So I think for the next few years at least, it's back to basics, where you try to understand what are the risks that you're taking at the early stage, and therefore what are the steps that you need to take for you to build a sustainable unit economics model. And I'm still talking only about unit economics, because you could still be making losses because your team costs are higher, etc. But at least the cost of building a product and selling the product should make you enough money for you to become contribution margin positive. That's I think one view which has changed. Um, Some of you could add on to this probably in terms of what you are saying.
I totally resonate. I think what I said before, team traction, market size. Oh, we saw a lot of teams getting funded without having even a market to address to, because, like Rohit said, there was enough liquidity in the ecosystem that was getting exploited. But now, post this one circle that we've seen, unit economics and profitability are going to be a very, very key variable to be looked at whenever, even from a very early stage. So, even from our example and standpoint, the kind of portfolios that we are now getting post the rate cuts and post this liquidity crunch, there is that filter that has already happened, and the quality of the startups that are coming forward, founders are savvy of this point that they will be asked about unit economics at a very early stage versus they could have pivoted twice or thrice, even once before. Anybody could have asked about, oh, how will you make money? So the question is how you will make money has now taken precedence, even at an early stage, and which is absolutely true, absolutely correct way to look at it. But I think the basics that we thought, right, team traction, market size, and then we can keep on adding unit economics, profitability. These are a few factors that from Indian ecosystem and even from global ecosystem, given the liquidity crunch that is there, all five at least need to be ticked. Maybe 4 out of 5 needs to be ticked for a yes decision to be there.
Sure. No, great insights, and I think I kind of resonate with you all, both of you, that end of the day, investor is considering with if this problem is big enough to solve. Founders are great, and will they be relentless in pursuing this idea and startup? I think that has been my kind of learning that sometimes angel bet on founders than the idea. So I think that is one thing. It's also happening in India. So the question of Vinod, that it's also about being founder quality, so to say, also an important element of this conversation as well. Now, the next conversation, it's also there is a question, but I'll take that question after this conversation. Is what is a type of startup which you personally prefer investing in, Sambhav and Rohit? And we have heard terms like early stage investments. Could you elaborate on this question? Because early stage is like a very subjective term for everybody, right? So, can you share some basic rules of what is early stage investment, so to say? And also, what's your thesis around early stage investment? That would be a really great insight. And then we'll pick up Dishant's question, which is fairly related to this topic.
Rohit, you want to go first?
Yeah, sure.
Right?
See,
Yeah, but
early stage is ideally when you're building the product, right? And you build a product, whether it's physical or digital, and you're trying to get customers for this product. You do not know whether you'll get customers. You do not know whether they'll pay for it. So these are all, or you do not know whether you can build a product in the first place. So these are the unanswered questions, and therefore you raise capital to answer these questions. If all of them get answered, the potential of you raising a Series A or a Series B is higher. The way we see is anything above a Series A is probably not early stage, and anything before that is early stage where some or all of these risks exist.
sure. Samba, your take.
Yeah. Totally resonate. Just on the terms of life cycle of a startup, I would say anything up to product market fit is what we'll call as early stage, because beyond the product market fit, it's about scale, where the money will come in because you have a product that can be sold. So whatever is happening till that time, because there is a high risk as compared to when you have established the product market fit, we'll call that an early stage, where there will be some pivot, some sort of a flexibility that will be required from the founding team, because they are also experimenting to find the product market fit, which I personally feel with the VC framework, that kind of a freedom is not there. Of course, there could be a good VC on board who might synergize on that front. But at times for a founder, it has to be very quick decision making to do some very quick tweaks to reach to the product market fit. So till that stage, I will personally say that that's what we call early stage. Once PMF is established, it's just about going to the market and scaling. That's beyond the early stage.
Sure, sure. Now also, Dishant has this question: should financial projection be for 3 years or 5 years? Should they be broken down monthly or quarterly? Asking for an early stage pre-revenue startup. Very related question. So, and can you relate it with this conversation of early stage, investment? What would you say for that?
Yeah, I mean, if you're pre-revenue, it's very hard to predict even 12 months, let alone 3 years or 5 years. So the way we see it is ideally monthly projection for the next 12 to 18 months is ideal. Anything beyond that is ideally not your job to extrapolate, is the VCs or the angels' job to figure out how large could this opportunity be and therefore is it worth investing on that. But the first 12 or 18 months is what is actually in your control. Beyond that is not.
Sure. Great. Somehow
Yeah.
your take?
Yeah. So the only problem that comes here is our trust system in this ecosystem, because that you cannot raise money without any valuation, and for that valuation you need at least 5 years of projections. So it's that dilemma within the ecosystem that you don't even know the revenue today. How will the revenue start flowing in? And at that stage, you're asking the founder to say, "Give me a 5-year projection," because you have to have a valuation for raising the round. So there is that anomaly, possibly in the West, or you say if you raise fund in Singapore, that kind of thing is not there. As long as the money lands in your bank account, they are okay. Right now, we are still on that path to reach to that trust where government can say, "Oh, you raise the fund in the bank and will not ask you the question around valuation." But today, that's not the reality. Even at day zero, you don't know where you will have the money coming in from. The government will say, "We need the DCF to give you the compliance certificate." And for that, and not just for that, I think even from a unit economics perspective, if the assumptions are to be tested, then you need to have at least short to mid-term projections in place, at least like Rohit said, 10 to 18 months, at least for 24 months. And then that can be extrapolated from the valuation perspective. But as a good founder, good to do thing is, of course, you might not have a skill set to build a formal projection sheet or a financial projection sheet, but at least the assumption or unit economics is something that only the founder can articulate perfectly. That should always be there, even at day zero when you think you are solving a problem. That unit economics and the assumption sheet based on which these projections will come out, that should always be present. And that at that point of time, founder should not be thinking, "Oh, that I still have to think about. I know what the solution is, but I still need to think about what are the dynamics for pricing it and all of that."
Sure. Rohit, you
So
want
the
to add
question,
something? Sorry.
yeah.
Sorry. Please go ahead.
So the question actually asked about monthly, quarterly. So till the time pre-series or series A where the VC comes in, right? Till that stage, to be honest, the informative rights are not exercised by angels so diligently that they go after a month on month to ask for the data. So at least a quarterly comparison could be a helpful approach. But once the VC comes in, of course, then there is a monthly MIS that is mandated, and all of that needs to be done in. So I would suggest post the VC stage, a monthly approach should always be followed.
Sure. Rohit, you want to add on something or should?
No, I don't have anything else to add.
Okay, great. Now, farmers looking for money and investors looking for exit. What's a typical check size for Indian VCs? Should is there any kind of typical in the Indian ecosystem you would want to recommend that hey, for this amount inputs are better, for this amount VCs are better. So who would like to go first on this one? Sambhav, Rohit?
Sambhav, probably you could go on.
Yeah, Sambhav.
Yeah, so given the again the recent dynamics, the angel round starts, you can have a 5K ticket size to invest in 5,000, and then it can go up to 2 crore rupees. So that's about roughly about 1K to 250K of a ticket size at the angel stage from the Indian ecosystem perspective. You go to US, that then this of course this changes according to the market dynamics. The angel ticket size could be anywhere between 100K to 1 million also. So because of these different, of course, still has to be perfectly tested on the compliance front. But there are these platforms through which even a small ticket size investments can be done for 5,000, 10,000, and it can be done in multiple of these entities. From the VC front, I think post 1 crore to say up to 10 crores is the typical ticket size that comes in. But I'll let Rohit add to these numbers if he has something else to add in terms of data that he has.
Yeah. I think you see, ideal seed round is like $1 million, and that could be a mix of a lead VC and angels or other smaller VCs, etc. From our fund, we typically invest 4 crores as an average starting, and then keep investing till Series A, Series B, doubling down what we like. So, and anything before that, usually 1 crore is too small a size to raise from a fund. So that ideally could be bootstrapped or family and friends or members. Anything more than that, you have the opportunity to at least talk to a VC and try to raise.
Sure, sure. And one conversation around angel work, and VC is also there are a lot of family offices which are there now. There has been some recent news article as well that they have really doubled the money in a very very short time doing these investments. So how do you categorize them? More in angel side or the VC side, and what's their typical approach towards investing? Some bit of insights on family office, how to deal with them will be a good insights. Somehow you may want to go first because yeah.
So I've not dealt with a lot of family offices per se on a lot of deals, but there are both approaches to it. Family offices do have VCs through which they kind of will want to deploy their funds. They will want to have a professional firm managing it, where they might not want to take the individual decisions unless the professional firm has looked into it, or they'll co-invest with with this professional firm. But there are these family houses which have a sector specific domain expertise, and they have a decent in-house team itself where they want to kind of specialize and work around in that domain itself, and then they can be the lead, or they will want to kind of accelerate and incubate those startups because they are having a domain expertise because of which the family office exists in the first place. So there are both sides of the stories. But I don't have a lot of insights on how family offices kind of co-invest with or have VCs as a partner. Maybe Rohit can throw some light on that.
Yeah. So the larger family offices can co-invest with VCs in their companies. They come in at later stages, and you also have family offices which come in very early at the seed stage or pre-seed stage. So I think the way to look at it is to understand if the investment decision is decided by the family itself, or do they have like a professional investment team taking the decisions on behalf of them or in conjunction with them. Right? I think that's important to understand. If you have a professional team, then you're probably taking it more seriously. And if you're taking the decisions yourself, then you can look at it as an extension of an angel investor. It's just that
Sure.
it's under a brand name where you have probably more capital to invest, but all other characteristics remain the same.
Sure. Sure. So we have one question from Nidhi. Some startup in consumer goods space need investment and funds early on for scale up. Yet investors, both angel and VC, look at numbers. Now getting numbers as high CAC, and also need heavy investment in terms of building a digital presence, customer retention, etc. Too early on. Hence, month-on-month increase in growth or users is difficult to achieve for a bootstrap startup, even if the product is scalable. So I think it's a bit of question around, typically how do you model, a consumer good kind of space where there is a lot of variables around CAC and competition and all that. I think great question, but again, some insights, and then we can get back to this conversation.
Yeah, see, the way we look at brands, it's actually very hard to justify or judge at the very early stage, right? We invest when companies are doing 5 lakhs in monthly revenue and try to help them scale. But having said that, we do very, very limited investments at this stage because the risk is very high. Sometimes the CAC is high because the product is not well received by the PG. It's not because of lack of branding or lack of marketing. It's just probably because there is no product market fit from a B2C brand as well. And we've seen cases where there have been companies which have bootstrapped to a 60 crore, 80 crore annual revenue also, unprofitable, where there is just a great product market fit that they do not need money because working capital you can fund it through banks and your P&L is profitable from day one. So, and what we've noticed since 2017 till now is that it's actually easier to scale a B2C brand now than before. Hence, the expectation from VCs and investors that if you believe that the product is needed in the market, then you can actually get to 10 lakhs of monthly sales without that much of a difficulty. Beyond that, I agree, you might need to invest more in working capital and branding, etc. But that basic proof of concept can be established.
Sure. So, Sambhav, any views on this?
Yeah, so maybe I have not understood the question correctly, but just continuing from Rohit's viewpoint with D2C space from Indian context, given the demand slide that we have, is not that difficult to crack, but there are many people out there who are about to crack that. So if you're not able to bring down your CAC with a planned approach, then that's a red flag, because somebody else is then going to do that. So it's not going to be a vacant space for a very long period of time. And hence those number tracking becomes very, very critical and to be established before any further capital can be plugged in to bring that CAC further down. It should match to the milestone based approach versus no impact coming in, and then we keep on burning money on that front.
Sure. So when startup approach you, Sambhav and Rohit, both of you, question. So angel and VC perspective again here. Both typically do their due diligence, right? Can you share some kind of difference, and what are the common due diligence practices in the angel investing and the VC investments? That would be a really great insight for a lot of listeners here on what are the typical difference, and also what are the typical elements of due diligence in either angel and VCs. So maybe Sambhav, you want to take a first step on that.
Yes, one field that needs a lot of attention from Indian perspective, because we need to be a lot compliance oriented, and at a very early stage, angel stage specifically, there's not a lot of data to be looked at. That's perceived by angels that at what to do with diligence at this stage, there's hardly anything in the company. But even at that stage, a lot can be established through a small subset of a diligence exercise that should be done. But in most of these deals, we are looking at least at the angel stage, that even basic level of diligence kind of sometimes is missed out. Maybe there's not a deliberate attempt for that, but it's just that in that horizon of just completing the round, or let's get rolling, there is nothing much, founders have just started. There could be a lot of story behind that can still be unearthed. So the problem that comes here again is, we'll touch upon it in some other topics also later on. I'm sure there will be more on this, but legal and finance for founders is a very low hanging fruit early on. And there are misses, right? Specifically from the incubation spaces where we've seen those who've raised money from incubations and then they've gone into a subsequent round. The call for money is delayed because there is a lot of historical work that still needs to be done. So our money that should have landed in the account within 10 days kind of lands up in the account in 2 months' time. So that's 2 months of efficiency lost, right? Because there was a small DD that could have solved for it early on that did not happen because that was a cost, we don't need it at that point of time. Coming to a late stage DD, again, the perspective is once the term sheet is signed, the investor has some sort of confidence in the team that's kind of running the show. So we've seen a lot of these cases where there are considerable red flags, but at the end of it, they will end up becoming condition precedent of SHAs to be solved for, which again will kind of delay the call for money to end up in the bank account, which again will delay the deficiency. So the DD comes as a mandate from investors. From founders' perspective, there should be a readiness for the DD that can ensure that the rounds get closed faster. And VCs also feel more confident while they're having all the answers that they have asked on that DD questionnaire.
Sure, sure. Rohit, your take, what do you check when you take on VC due diligence and when you typically put your money in?
So, I mean, see, we do founder reference checks, like, we do that. And also we speak to customers. This is before the term sheet is signed, before we make a decision. And after we make a decision, then it's about the legal diligence and the financial diligence. See, at the early stage, you could possibly overlook some of these things. But the way I think about this, the more money that's running through your system, whether it is through funding or revenue, whatever it might be, then your handle on finances need to be really, really good. Probably you should do like internal audits once in a while, even before a investor mandates it, etc. Just so that you understand where your money is coming from and where your money is going. If you know this, then the financial diligence, when it happens, it's much easier to handle. If you do not know this, then the chances of a round breaking down also is fairly high. Legal diligence, unless there are like very, very big red flags, it usually does not happen. But financial diligence, in my opinion, is more important.
Sure, sure. No, thanks. Thanks for sharing. And I think from our practice in terms of IP and what we have seen with a lot of startups as well, that typically in the due diligence, either in the VC or the angel, typically there is no clarity on their asset where it is. Right, even like IP sometimes is not sorted. The brand is on founder's name. Things are not really in place. NDA is not in place. And I agree with Sambhav that it gets delayed and just takes a lot of time sometimes to really get it fixed because there are government processes and databases that needs a lot of change and takes a lot of time to happen, right? So I think what I would say that success lies in the basics, that sort your financial, sort your legal early on and make a process and run it like a listed company. I think once you start doing that, I don't think any due diligence will be a problem for any of you as a VC or angel, right? Great. So here is a pitch moment for you, and probably we are towards the close as well. Angel investor or venture, what a startup choose you over or other, and what are the pros and cons working with either angel and VCs. So some kind of a pitch from angel and VC would be a great conversation here.
So, Sambhav, why don't you go?
Yeah, let's go with angel first.
You want the angel within me to pitch it, or the angel community or as a whole?
Within you. I mean, what would you say that why startup should work with an angel? What are typical pros and cons to work with you, of course, and apart from money, what typically founders should look at when they are choosing between angel and VCs. So some bit of kind of closing and summarizing what we have discussed, really.
Yeah. So personally, I would say I have plethora of failures that I have seen, especially early stage. And when you ask the question to public at large, what could be the basic reason for startup failures? They'll say, "Oh, funding crunch was there, or product market fit was not found." But there are other legal issues that are prominent because of which startups do fail: co-founder conflicts, investor fiascos, which kind of doesn't come in, especially the first time founder. Oh, ye bhi hona tha. This is what I was supposed to expect. So one is we have a sector agnostic experience, specifically early stage, because the dynamics are sector agnostic, different, so we know what works, what doesn't work at an early stage. Second, we kind of seen a lot of failures, so we know how to plug them at a very early stage and help help the founding team to approach the scale side of the startup cycle faster. And third is we tend to bring in that dynamics of considering legal and finance as not an expense but an investment, because this is the only function that can talk with every other function in the organization once you grow, once you have that departmental approach. Solving it at that early stage will help you propel faster towards your growth path. So that's what differentiates the our angel side of the story.
Great. Thanks, Sambhav. Rohit, your take on VCs and would be great insight on that.
So, yeah, I think from a VC point of view, if you think your startup needs a lot of money and has a lot of risks that need to be solved, then I think it's ideal capital to raise from a venture fund, because we expect like 60% of our companies to not do well, and we're completely okay with that, right? So we're taking that risk, and therefore, some of my closest friends now from the ecosystem are companies which did not do well from our first fund. We still end up being close friends with them. So, and we also know that when a company does really, really well, you end up creating a lot of wealth, both for the founders, for the VCs, as well as the LPs of the VCs, right? So, because it's an institutional approach, we're able to guide at least to the PMF stages. And there have been cases where we also realize that PMF is not possible. In those cases, it's just better to accept what the market tells you and then return the capital or shut down the company. So that's probably the right thing to do. So I think from a seed stage fund, we are able to guide a company from building a product to taking it to as close to PMF as possible, and making the connect to a Series A or a Series B investor and help you raise the next round. Right? For example, from our fund, 80% of our companies end up raising a Series A. Not that after that there is no risk. There is risk even after Series A, but at least that first step is solved. So that's sort of what we help you in. And if that is done, then I think the risk beyond Series A is usually lesser. It's not as high as the chasm that you see between Series 2 Series A.
Sure. Great. Thanks, Rohit. And I think this is, I don't know if it's a question or just a comment from Nidhi. Shouldn't VC and angel investor look at market potential, product market fit, and acumen of founders rather than market share, month on month growth, etc.? I think from my perspective, if I take a stab on this question, is that it's always an amalgamation of a lot of points that Sambhav and Rohit has touched upon, in terms of founder quality, market share, traction, like Sambhav mentioned. So I do believe that's also my understanding. Sambhav and Rohit, you want to add something, or did I go off track? But anything that you would want to say, that it's not only the numbers, it's also a lot of factors which go into investing, right? So maybe that could be also a closing conversation. So some feedback on and some answers around this comment would be great insight here.
No, of course you're right. Like, I think the market potential, the founder's caliber, and also the product is what matters at the early stage. If everything is solved for, then you're not taking any risk, and therefore capital should not be so expensive, right? I agree with Nidhi. Nidhi, you could reach out to me. Happy to have a conversation and understand what you're building, and then probably give you some more minute feedback, or take the conversation forward in terms of investing as well.
Sure. Great. Thanks for offering that. Sambhav, your take, and I also want you to also share a bit more how you help startups. What kind of startups should be, should be okay for them to reach out to you. So a bit of more about how you can help the ecosystem and my audience as well. That would be a really, really great addition in this episode as well. So help us a bit more about your approach towards investing, and also it's a time for you to pitch you as an investor, right? So go ahead and do it.
So we kind of have funneled in the early stage market, right from even before incorporation, when a founder is conceptualizing what kind of entity needs to come into picture, up to Series A, because post that the institutions have a mandate of who they want to run the show from there on. we kind of look at that life cycle. That's our area of expertise, where there is a lot of compliance show to be thrown, but the founders do not understand that nuances. Should they focus more on the product, or should they focus more on the regulatory? That's the battle. So where we come in as a founder-friendly, affordable service provider firm is focus on the product. Let us focus on the regulatory, and let's scale you faster. Let's get you more time. Time is critical. Time is your money. Investors will give you the fund, but you still don't have the time. So we'll create that time for you to scale faster by solving for those legal and regulatory requirements, even at a very early stage, which are there, but at a later period of time, there are misses, and it takes a lot of efficiency and effectiveness out at a later stage. We are kind of protecting you from a very early stage, so that when you scale faster, efficiently, and then you don't have to look back to solve for XYZ items later on. So yeah, that's about us.
Thanks. Rohit, your closing pitch and some bit of more about WH Ventures. What kind of investment do you do? Will it be okay for people to reach out to you? That would be great.
Sure. See, we do a lot of consumer investment. We've invested a lot in media and entertainment companies, content companies, gaming startups. We've also done commerce and consumer brands like D2C brands, which have been successful. And the third area of interest for us is fintech. So we were early investors in Small Case, we were early investors in Jar. So that again is a space that's done well for us. Having said that, it's not that we do not look at B2B, SaaS or AI, etc. We do look at that. It's just that our bent of mind is more tuned towards consumer startups. So if you're building anything in the consumer tech or consumer brand space, you could reach out to me. Our check size, like I said, is 4 crores on an average. So we'll be able to support you at least for a seed round for sure, if not more. I'm at Rohit at whventures.com. So it's fairly simple ID, so you can reach out. Happy to have conversations.
Sure. Great. No, thanks, Rohit, and also any of the listeners. We are here as the pitch opportunity. It also on to me. We help companies and startups with their entire IP life cycle, like somewhere very early, right from understanding what they are doing and protecting it with patents, trademark designs, or however we can help them to safeguard their investments as well at the very early stage. So with that, I would like to thank Sambhav and Rohit, both of you. A lot of great comments, Captain Anil and maybe Daniel. A lot of people have, Dishant has questions and great engagement. Thank you for being on the platform. Really appreciate your sharing this very invaluable knowledge. Wish you the best, and thank you for being here.
Thanks a lot for having us.
Thanks. So choosing the right fund source is critical decision that can influence your startup journey and success. I hope this episode has provided you with some or more right amount of information and food for thought to begin your journey. And thank you for being here and supporting the startup series. We have one more episode in this season, and it's going to be a very exciting. We are going to announce it this next Monday. I'm sure we will announce this. It's on 21st of June, and it's a very exciting session. Please do join. Please block your calendars and follow me on Arctic Invent and LinkedIn, and do follow our page to get updated about when we are doing these next lives, and prepare a question in advance. I'm sure it will be a great interaction. Thank you once again, and thank you for all the audience. See you in the next episode.